Welcome to the deep dive. We love sifting through all that financial noise out there and bringing you the stuff that really matters. And today we're going to tackle a topic that I think a lot of people find kind of mysterious: discretionary trusts.
Yeah, trusts, they have kind of a mystique about them, don't they?
Yeah,
But they can play a really important role in inheritance tax planning here in the UK.
especially in the UK, right?
Right.
Okay, so we've got a fantastic blog post from MA and CO accountants to help guide our deep dive today. It was published November 19th, 2024, so very recently. And they really do a nice job of breaking these concepts down in a way that's easy to understand.
They really do.
So let's dive in. First things first, what exactly are we talking about when we say discretionary trust? I think a lot of people hear trust and they immediately think like family drama.
Right, like a soap opera.
Yeah.
Yeah, not quite that dramatic in real life. In simple terms, it's a legal arrangement where assets are managed for someone's benefit. So the person setting up the trust, you put assets into it, and then they're managed by trustees that you choose.
So these trustees are kind of like financial guardians.
Exactly. They're looking out for the beneficiary's best interests. And the discretionary part, well, that means they have the power to decide how and when those assets get distributed to the beneficiaries.
Okay, so there's some flexibility built in there. They can make adjustments based on, life changes and stuff.
Exactly. Think of it like having a toolbox, right? The trustees can pick the right tool for the job, whether it's income, a lump sum, or even just holding on to the assets. It all depends on what the beneficiary needs at that moment.
That makes a lot of sense. So let's talk about the elephant in the room here, inheritance tax. How do these discretionary trusts actually help with that?
Well, one of the main advantages is that the assets in a discretionary trust, they aren't automatically considered part of your estate when you die. So this can potentially lower the amount of inheritance tax your beneficiaries would have to pay.
So it's a way to strategically manage, what the tax man sees.
Exactly. And it can be super helpful for people whose estates are worth more than the nil rate band, which is currently £325,000.
Like the NRB, that's the threshold below which no inheritance tax is due, right?
Exactly. If your estate's worth more than that when you die, then inheritance tax kicks in.
Okay, so that NRB, that's a pretty important number.
Yeah, definitely keep that in mind. And gifting is one way to potentially make use of the NRB. You can actually gift assets into a trust while you're still alive.
But wouldn't gifting trigger a tax bill right away?
Not always.
Yeah.
If you gift an amount within the NRB, there's no immediate inheritance tax charge. And get this, if you live for 7 years after making the gift, it becomes completely exempt from inheritance tax.
So there's a little bit of a waiting game involved.
Yep, it's called the 7-year rule.
The 7-year rule. Okay, so thinking long-term gifting within that NRB and surviving those 7 years could be a pretty savvy move.
It could be.
But what if someone wants to give more than the NRB? Let's say they have a larger estate. What happens then?
Well, in that case, there's an immediate entry charge of 20% on anything exceeding the NRB.
Ooh, that sounds kind of steep.
Yeah, it can be a significant upfront cost, but you have to weigh that against the potential savings down the road. If those assets just stayed in your estate, the inheritance tax could be a lot higher when you pass away.
So it's all about finding the right balance.
Yeah, exactly. And there are other strategies too, like spreading out your gifts over time, making smaller gifts within the NRB every few years. Sometimes it's called sequential gifting.
So instead of one big transfer, you're making these smaller gifts over time to kind of chip away at that potential inheritance tax liability.
Precisely. And that can be a very effective approach, especially if you start planning early.
That makes sense. Okay, so we've been talking about gifting assets while you're alive, but what if someone isn't ready to do that? Are there ways to use trusts for inheritance tax planning without actually giving up control of your stuff while you're still here?
Absolutely. You can actually set up trusts as part of your will. It's actually a very common approach.
Oh, so the trust kicks in after you're gone.
Exactly. And there are a few different types of will trusts to think about.
Well, that sounds like a perfect topic for the next part of our deep dive.
It is. We'll get into the nitty-gritty of those different types and see how they can help you achieve your estate planning goals.
Sounds good. We'll be right back after a quick break.
See you soon.
Okay, so we're back. And before the break, we were getting into some pretty interesting stuff about using trusts within a will as part of inheritance tax planning.
It's a really smart way to address those tax implications, without having to give up control of your assets while you're still alive.
Yeah, exactly.
Yeah.
You get to enjoy your stuff while you're here, and then it's taken care of according to your wishes later on.
Right.
Okay, so you mentioned there are different types of will trusts.
Yes, there are. The ones that MA and CO mention in their blog post are nil rate band trusts, residence nil rate band trusts, and interest in possession trusts.
Okay, so a lot of different options. Let's break those down one by one.
Sounds good.
First up, we've got the nil rate band trust. We talked about the NRB earlier, right? That's the tax-free allowance. So is this trust specifically designed to use that allowance?
You got it. A nil rate band trust basically shelters that amount, which, like we said, is currently £325,000 from inheritance tax when you pass away.
So it's like carving out a piece of your estate that gets passed on tax-free.
Exactly. And you can combine it with other strategies to potentially shield even more of your estate.
Interesting. Okay, so that's the nil rate band trust. What about these residence nil rate band trusts? Does that have something to do with your home?
It does. The residence nil rate band, or RNRB, is specifically for passing on your primary residence to your direct descendants. So that would be your children or grandchildren, typically.
Okay, so let's say I want to make sure my house goes to my kids without a huge chunk of it going to the tax man. Is this the trust I would want to look into?
Exactly. The RNRB currently adds another £175,000 to the tax-free amount you can pass on.
Wait, so hold on a second. Does that mean a couple could potentially pass on £1 million tax-free if they use both the NRB and the RNRB?
That's right. It's a pretty significant benefit for people who want to keep that family home in the family.
Wow, okay, that's pretty impressive. All right, so we've covered nil rate band trusts and residence nil rate band trusts. Now we've got this last one, which is the interest in possession trust. And that honestly sounds a little more complicated.
Yeah, it has a slightly different purpose. This type of trust is often used to provide a regular income to a specific beneficiary, maybe like a surviving spouse. But the key here is that it can potentially shield the assets themselves from inheritance tax when that beneficiary eventually passes away.
Oh, so it's about making sure someone has financial support without necessarily giving them full control over those assets.
Exactly. It can be really helpful for estate planning, especially if you want to provide for someone while also being mindful of the tax implications for future beneficiaries.
Okay, so we've talked about these different types of trusts and how they can potentially save on inheritance tax. But let's be realistic here. Setting up a trust sounds like a pretty expensive thing to do. Is it really accessible to the average person?
That's a common misconception, actually. MA and CO give some cost estimates in their blog post, and a basic will can cost just a few £100s. And adding a simple nil rate band trust might add another $500 to $800 on top of that.
Oh, so we're not talking tens of thousands of pounds here.
No, not at all, for a basic setup. And remember, trusts that are part of your will don't have any ongoing costs while you're still alive. Those costs only kick in after you're gone.
So it's like a one-time investment that could potentially save your beneficiaries a lot of money down the line.
Exactly. And if you have a more complicated estate or specific concerns, the costs might be a bit higher, but it's definitely still worth exploring.
Yeah, I think that makes sense. So you've mentioned MA and CO accountants a few times. Do they specialize in this kind of work?
They do. They offer inheritance tax planning services and can walk you through the process of setting up and managing trusts.
So if someone's feeling overwhelmed or just doesn't know where to start, reaching out to a firm like MA and CO could be a good first step.
Absolutely. Seeking professional advice is always a good idea when it comes to estate planning. These laws can be tricky, and a good advisor can make sure you're making the right decisions for your situation.
Right. It's all about having that expert in your corner.
Mm.
But even with professional help, I bet some people still have some questions or hesitations about trusts.
Definitely. It's not something we deal with every day.
Right.
But luckily, MA and CO has anticipated some of those common questions and included a really helpful FAQ section in their blog post.
Oh, perfect. So they're addressing some of those concerns head on. What kind of things are people asking?
Well, they start with the basics. Someone asked, what is the nil rate band, NRB, and how does it affect me?
Right back to that all-important threshold.
Exactly. They remind everyone that the NRB is the amount you can pass on tax-free. And they point out that by using trusts strategically, you can potentially reduce the taxable value of your estate.
So they're emphasizing the importance of being smart about how you structure things?
Absolutely. Another question was about the 7-year rule we talked about earlier. Someone wanted to know, how does the 7-year rule work in inheritance tax planning?
Yeah, that rule seems super important for anyone considering gifting.
It is. They reiterate that if you make a gift and live for 7 years afterward, it's completely exempt from inheritance tax. And they highlight that using this rule over time can really help chip away at that potential tax liability.
So it's all about playing the long game.
Yeah, you could say that. They also address a very practical question. What are the immediate tax implications of setting up a discretionary trust?
I'm sure that's a big concern for a lot of people.
Definitely. And MANCO confirms that transfers into a discretionary trust up to the NRB during your lifetime are free from immediate inheritance tax charges.
Okay, so as long as you stay within that 325,000 pound limit, you're in the clear.
That's right. But they also remind everyone that if you go over that NRB, then you've got that 20% entry charge to contend with.
Right, that upfront cost. But I think they also talk about those periodic and exit charges, right? The ones that apply at different points during the trust's existence.
Yes, they do. They explain that periodic charges are taxes that are applied every 10 years if the trust's value is more than the NRB.
So it's like a check-in to see if any additional tax is due.
Right. And exit charges apply when assets are taken out of the trust. The amount depends on how long it's been since that last check-in and how much is being taken out.
Okay, so there's a bit of a dance you have to do there. Make sure the tax man gets his cut, but not more than his cut.
Yeah, it's about striking that balance. Now, another interesting question they tackled was, can I be a beneficiary of my own discretionary trust?
That's an interesting one. I can see why someone would ask that. But wouldn't that defeat the purpose of trying to minimize inheritance tax?
Potentially it could. MANCO says you can be a beneficiary, but they caution that if you're actually benefiting from those assets might not be fully removed from your estate for tax purposes.
So there are rules about how much you can benefit from your own trust.
Exactly. They actually recommend what's called a settler excluded trust, where you specifically exclude yourself as a beneficiary if inheritance tax is a major concern.
Okay, so it's all about creating that separation between you and the trust assets to make sure the tax benefits work the way they're supposed to.
Right. And they also clarify the difference between a discretionary trust and an interest in possession trust. They point out that in a discretionary trust, the trustees have full control over who gets what and when. But with an interest in possession trust, a specific beneficiary has an immediate right to the income generated by the trust, but not necessarily the capital itself.
So it really comes down to the level of control and what kind of benefit the beneficiary receives.
Exactly. Then they get into a question that I'm sure is on a lot of people's minds. Are there ongoing costs associated with trusts?
Yeah, that's a very practical concern.
Right. And they reiterate that with trusts that are set up within a will, there aren't usually any ongoing costs during your lifetime. The costs usually start after you're gone. But lifetime trusts might have some administrative costs, so it's always a good idea to talk about that with your advisor.
Okay, so you're basically weighing those potential costs against the benefits the trust provides.
Exactly. And then they revisit that residence nil rate band. Someone asked, how does the residence nil rate band, R&RB, work?
Yes, back to the house.
Right. They remind us that it's an additional allowance of up to £175,000 on top of that standard NRB when you're passing on your primary residence to direct descendants.
And like we said before, a married couple could potentially pass on up to £1 million tax-free using both the NRB and the R&RB.
Exactly. It's a pretty amazing benefit. They also address a question that I'm sure is on a lot of people's minds. Can I transfer more than £325,000 into a trust without paying immediate inheritance tax?
That's the big question, isn't it?
It is. And they're very clear that you can't transfer more than £325,000 into a discretionary trust without incurring those charges we talked about earlier.
Yeah.
However, they do mention that other types of trusts or planning strategies might allow you to transfer more without those immediate charges, but those can be pretty complicated. So definitely seek professional advice if you're thinking about going that route.
Yeah, it's not a simple yes or no answer, is it?
Nope. It really depends on your individual circumstances. That's why talking to a professional is so important.
Right, they can help you figure out what makes sense for your specific situation. And speaking of professional advice, that brings us to the last question in their FAQ, which is, why should I seek professional advice for inheritance tax planning?
It's a great question, and it really sums up a lot of what we've been talking about today.
It does.
MANCO emphasizes that inheritance tax planning involves some pretty complex laws that are always changing. So professional advisors can help you navigate all of that, make sure you're following the rules, and develop a strategy that really works for you.
So it's about having that peace of mind knowing you're making the right decisions.
Exactly. It's about protecting your legacy and making sure your wishes are carried out.
Okay, we've covered so much ground today. Discretionary trusts, how they work, different types, costs, you name it. But there's one thing I'm still kind of curious about.
What's that?
We've talked about the benefits of discretionary trusts in general. But MANCO also mentions some specific groups who might benefit from them even more. I'd love to dig into that a little bit and hear more about why these trusts might be especially useful for certain people.
That's a great point, and it actually leads us perfectly into the last section of their blog post.
Okay, great. Let's wrap up our deep dive with those insights then. Okay, so we're back and ready to wrap up our deep dive into discretionary trusts.
Yeah, we've covered a lot of ground, haven't we?
We have. But before we go, I want to touch on something you mentioned earlier. MANCO highlights some specific groups who might find these trusts especially useful. So let's talk about that.
Yeah, they point out that estate planning, it's not a one-size-fits-all kind of thing.
Right. So who are these groups and why might discretionary trusts be a particularly good fit for them?
Okay, well, the first group they mention is individuals with estates that exceed the nil rate band. So basically, anyone whose estate is worth more than that 325,000 pound threshold.
That makes sense.
Yeah.
We've talked a lot about how trusts can help reduce the value of your estate for inheritance tax purposes.
Exactly. So if you're already over that, limit trusts can be a really valuable tool to minimize that potential tax burden. Make sure more of your assets actually go to your loved ones.
Right, not the tax man.
Exactly.
Okay, so that's folks with larger estates. What's the next group?
The next group they highlight is parents and grandparents who want to provide for future generations.
Okay, so it's not just about minimizing taxes, it's about creating a legacy.
Absolutely. Discretionary trusts can be a way to ensure that your wealth is used to benefit your children, grandchildren, even great-grandchildren. You can even set some guidelines for how you want those assets to be used. Maybe it's for education or helping them buy a house or supporting them in other ways.
It's like a gift that keeps on giving.
I like that. A gift that keeps on giving. That's a good way to put it.
Okay, so we've got folks with larger estates. We've
Yep.
got parents and grandparents thinking about future generations. Who else?
Another group they mention is business owners.
Business owners. Okay, that's interesting. How do discretionary trusts fit into that world?
Well, for business owners, protecting their assets is a huge deal, right?
Okay.
And discretionary trusts can offer that extra layer of protection. They can shield those assets from creditors or lawsuits. This can be especially important if you're in a high-risk industry.
So it's like a safety net for your business.
Yeah, you could think of it that way.
Okay. And the last group they mentioned.
The last group is people who are concerned about care costs.
Oh, yeah, that's a big one these days.
It is, especially as people are living longer. Care costs can be a huge burden, but transferring assets into a trust might help protect them from being used to pay for care.
So you're making sure your wealth is there for your loved ones and not being eaten up by care costs.
Exactly. And I think what all of this shows is that discretionary trusts, they're really adaptable. They can be used in so many different situations.
They're flexible,
Yeah.
which makes getting professional advice even more important, right?
Oh, absolutely. Because a good advisor can help you figure out which options make sense for your situation. They can help you navigate all the complexities.
Well, I feel like we've covered just about everything there is to cover when it comes to discretionary trusts.
Hmm.
We talked about what they are, how they work, the different types, potential costs, why someone might consider using them.
And we emphasize how important it is to talk to an expert to make sure you're making informed decisions.
Exactly. So as we wrap up our deep dive into discretionary trusts, the question we'll leave you with is this: how might these trusts fit into your own financial planning? It's something worth exploring, and we hope this conversation has given you a good starting point.
Thanks for joining us for another deep dive.
See you next time.